Hey guys, welcome to this brief review of Chapter 12. It's not going to be that long, just going to cover some of the most important and basic elements that we need to cover for this particular chapter. Our chapter focuses on current liabilities, and that's where we're going to spend most of our time today, is discussing that. So first of all, current liabilities are important. And what are current liabilities? Well, if you think about it like this, a simple way of thinking about current liabilities is that they're the obligations that we're going to have to take care of within a year. So loans, for example, that we have to pay within 12 months. If you look at a more formal definition, it's current obligations that will be satisfied using current resources. So one of the more common current resources to use to satisfy an obligation, like a loan, would be cash. And so it's a trade-off between cash and the liability in most cases. The typical current liabilities we see are accounts payable, notes payable, sales taxes, and other income taxes that we have, as well as when we have wages for employees. All right, to start with, accounts payable, the most common type of liability that you see as it relates to the vendors and suppliers that we have. If you have a supplier, you contact them, request that they send you supplies, they send you the supplies, and they also send you an invoice. You take that invoice and usually pay within 30 days. So in this case, we have a purchase of merchandise that the terms are 210 net 30, meaning we're going to owe that invoice within 30 days. However, if we pay it early, we're going to get a 2% discount on that. So to put the inventory on the books using the gross method, we put the inventory at 800,000 and the payable will be 800,000. So the inventory is an asset. Then we credit the liability, which is a liability, right? So another liability that we see that's very common is a note payable. So this is just a straight up loan. We'll get cash, and in return for that, we're going to have to pay them back. When you first take out the loan, you do not have to worry about the interest. So they're telling us this loan is for $100,000. It's a 6% 4-month loan, but really we don't have to worry about the 6% 4-month at this point. We just put the amount of cash we're going to receive and then credit the liability for the note payable. Now, when the end of the month comes and we have to calculate the interest, it's $100,000 at 6%, and it's only over 4 months out of 12, so that comes to $2,000. So the interest expense that we have incurred is $2,000, and then we haven't paid it yet. We owe the interest on it at $2,000, so we put it on as a payable. That's our current liability. Now, when we pay off the loan, we first take off the liability, and then we take off the amount of cash that we're going to pay, and then we remove the payable. We don't have to worry about the interest expense because that's going to be incurred in the period of time in which the time passed, and so it passed up through June 30th, and so we're going to put it on that financial statement, the July 1st financial statement. We don't have the interest expense. We're just taking it off the payable. There's also something called a zero interest bearing note. Now, that doesn't mean there's no interest. You still have to pay interest, and so you can see that because the amount of cash we're getting is $100,000, but we're going to pay back $102,000. So we know that there's definitely $2,000 of cash there, but we don't put that as an expense because an interest expense has to be put with the period of time in which it's incurred, meaning time has to pass. Since no time has passed, we can't say that's an interest expense. So instead, what we're going to do is we're going to put it in like a holding place, this holding account called discounts. And so as time passes, that discount turns into an expense as the interest it becomes incurred. And we'll see that on one of the homework. The homework we'll look at in a separate video. All right, another current liability, sales tax. If we go to any retailer, we buy something, we're going to have to pay for the merchandise, and then on top of that we have to pay sales taxes to the state and local municipal authorities. The way sales tax works is that we multiply it as a percentage to the sale, and so the cash that the retailer collects is the amount for the revenue on the product they're selling plus the amount they're paying for the sales taxes, so in this case 4%, and so the entire amount of cash they collect is $3,120, but they owe $120. That's not their money. They owe $120 to the taxing authority. As far as income taxes are concerned, it's the same situation, except we're not collecting any money. But the situation is that we're incurring the taxes as we earn the profit. And so we want to put the taxes as an expense in the period of time in which it was incurred. And since we're not paying it until taxes become due, for example in April, we're going to put it as a payable and hold that payable there until we eventually pay it off. So the expense is going to live in the same period of time in which the net income was incurred, $300,000 in net income. So we're going to put in that same period the 20% tax expense. We're not going to pay the taxes until they become due, but we're going to hold that amount as a liability in the payable. Income taxes are usually current liabilities for the simple reason that you're not going to wait for more than 1 year to pay the taxes, otherwise they would be late. All right, another liability we have is employee related. Basically what happens with employee related liabilities is they work for us and we want to put the expense in the period of time in which they work for us. So if they worked for us in April, we want to put the expense for the wages in the April financial statement. However, we're not going to pay them until payday. So payday might be, May 5th, for example, May 10th. So we need to show the expense for the time in which they worked and hold that expense in a payable until such time in which we pay them. Now, another thing that comes in place with payroll is that not only are we holding on to the employee's portion, but we're also withholding the federal state taxes, FICA, like Social Security, Medicare. We also have payroll taxes. So all that stuff is coming out of the transactions that that result from the employee working. So let's go ahead and like the gross pay for the student, we can see the gross pay for the employee, we can see is $1,667. We're not going to give them all of that because we're going to withhold taxes as we're required to do. And this is going to be a payable to the taxing authority. We might also withhold health care premiums, retirement savings, other things such as union dues. All of these are going to be payables until we actually pay those organizations. So none of this money that's withheld from the payroll is going to be something that we're keeping. Instead, we're going to have that as a current liability to those different organizations. And then this take-home pay is going to be a liability as a wages payable until we actually pay the employee during payday. So using this example, here's our payroll of $10,000. We have the FICA and Medicare at 7.65%, federal withholdings at 0.8%, federal and state unemployment taxes at 0.8% and 4%, and we're going to withhold taxes of $1,320, and we even have union dues that they associated with this. So what you do is you put the gross amount, the $10,000 as salaries and wages expense. You're going to withhold the withholdings, we know is $1,320. FICA is 7.65 or 0.0765 or 765. Union dues are 88. Now notice you don't have federal and state unemployment, the employee doesn't pay that. So this is coming out of the employee's paycheck. None of this is coming out of our pocket, so to speak. It's coming out of their paycheck. So they don't have to pay federal and state unemployment. That's going to be something we're going to have to do in a separate transaction. So since we've got everything else, then find out what the net is, what's left over after that, and that's going to be the amount of cash that would end up being paid to the employee. Now, as far as payroll taxes are concerned, these are what we have to pay that doesn't come out of the employees' payroll, out of the employee's paycheck. We have to pay our percentage of FICA taxes. So the employee pays 7.65%, and the employer also pays 7.65%. So you have what is that? Over 15% is going to actually go into the federal coffers based off of the payroll, but the employee only pays 7.65%. The other 7.65% is paid by the employer. So we have this is what we're paying. Federal unemployment and state unemployment we said was 0.08, 0.008, and 0.04. This is all what we're going to have to pay. So that's going to be our payroll tax expense. Now when that comes due, then we'll remove these payables and we would credit cash at the time it's paid. So this is the payroll taxes. A couple of more slides just and current liabilities, and one of them is unearned revenue. Unearned revenue is where we've collected money before we've done provided the product or provided the service. So, for example, I'm supposed to fly out for a conference, and I bought the airline ticket. The airline hasn't done anything; they haven't flown me yet. So they've received the money, so they owe me a flight. So that's an unearned revenue. And you see the same thing for subscriptions, any kind of subscription, a Hulu subscription. If you get a subscription for software, you pay them, but they haven't provided the service yet, and so that's going to be unearned revenue for them. Hotels, same thing if you pay them in advance. Gift cards are a form of unearned revenue, because if you buy a gift card, you're just paying the company, like for example Amazon, you're just paying them money, but they haven't done anything for you, so they're going to owe you some kind of product or service, and so that's going to be unearned revenue until they actually satisfy that. All right, I hope you enjoyed that and it was useful for you. Have a nice day.